Hi, everyone. I'm Leslie Picker. Thank you, and welcome to our panel on M&A, Dealing with Uncertainty. We're tackling the subject from all angles. We've got two bankers, two lawyers. We've got a view from Washington, a view from the boardroom, and we're going to start with a reflection on this unprecedented year. And then we're going to move on to some key topics like SPACs, ESG, and of course, the power of big tech. During the last 10 or 15 minutes or so, we'll have some time for questions. So feel free to start thinking of those now. But let me first introduce the panelists. Joining me are Makan Delrahim. He's the Assistant Attorney General of the Antitrust Division of the U.S. Justice Department. John Huwiler, Managing Director, Global Head of M&A at Jeffries. Amy Lissauer, Managing Director, Global Head of Activism and Rate Defense at B of A. And Melissa Sawyer, Partner Managing of Mergers and Acquisitions at Sullivan and Cromwell. So first, let's start by kind of reviewing this unprecedented year in M&A. There was $2.9 trillion in worldwide M&A activity for the first 9 months of the year. That was a decrease of about 18% year over year, the slowest opening 9-month period in 7 years, according to data from Refinitiv. But that picture would actually look even worse if not for the third quarter, where there was a 94% increase over 2Q. So starting with you, John, what drove the C-suite confidence to ink deals in the last few months?
Well, I think, the beginning part of the year, starting in March, was really quite challenging. And as many of our guests would know, uncertainty is really the enemy of large-scale M&A activity. In the public company boardrooms, when there is a great deal of uncertainty, the tendency is to look within and really focus on operations and whatever a particular company needs to do to shore up their position, such that they come out the back end of whatever situation you're facing, intact and with strength.
We can turn to Amy, where we've seen a similar resumption of activity that's taken place in activism. In March, activists were largely withdrawing nominations and they were paring back positions. And now it seems like they're increasingly back in business, but they're not really doing activism in the way we traditionally think of activists, calling for buybacks and cost cuts and layoffs and so forth. Has 2020 really changed their tone?
Yeah, it's a really, really good question. So absolutely, I agree. If we look at the numbers, so for 2020, activism levels were down significantly. And so they were down over 40% compared to 2019 levels. Not surprising, we saw that basically occurring in the March and April timeframe. And that's because if we think about when companies' annual meetings tend to occur, they tend to be in the spring, and you see a lot of activism activity occurring in the March-April timeframe, of course, aligning with the of COVID volatility. And if we look even at an indicator of that volatility, and we look at the VIX during that period of time, it hit a record level of 82, 83 actually in March, compared to pre-COVID levels of about 17. And now it's still trading somewhat elevated around 28. And so a lot of volatility means too much uncertainty, and a lot of activists backed away from campaigns. That being said, we actually still saw some activism this year. So first, I would say we saw activists successful because they shorted the market, and whether that be outright shorting the market as a whole or shorting specific subsectors of the market, like the commercial real estate market, those plays ended up being quite successful for them. And then just if we think about it in terms of actual kind of more metrics relating to activism campaigns, what we saw was that activists gained over 60 board seats so far this year, which is less than 2019, but still quite significant. And so to your point on, are we thinking, what are we seeing for 2021? What are we thinking? And we are actually seeing some green shoots, and we are expecting that the activism market is going to return quite aggressively. A few reasons for that, and in terms of how we think it might be changing. Well, first, at B of A, we actually do track activist funds, and we keep track of what positions they hold each quarter. And so while we don't have access to third quarter 13F data yet, what we are able to see is that for the first half of the year, activists put to work an incremental $27 billion of capital across over 250 new and increased positions. So we see them actually gearing up. And then I would also say that we're seeing some, to Leslie, to your point, some high profile situations where we're seeing activists disclose big name positions more frequently, whether it's because there were a big activist conference recently or just more conferences like this actually occurring where activists are disclosing positions, it does feel like it's coming back. And then I'm sure John will go back to this, but as we see the M&A market come back, that's another lever that activists tend to like to pull. And so with M&A returning, and interestingly, M&A deal premiums being higher in light of stock prices being lower, we are seeing, again, a return to activism levels. And then in terms of how it's changing, I would say, I think you're absolutely right. It is a little bit different, and it will be interesting to see how that ultimately plays out. And we'll, of course, see that in the weeks and months to come. But in terms of some big trends that I think are changing, I would start by just saying first, what's been interesting is that it isn't just necessarily sell the company and buy back stock, kind of the generic themes that you see an activist look for. In one situation quite recently for a very large cap company, we saw the activists actually specifically call for the company to suspend their dividend and use those billions of dollars to reinvest in the business. So very different trends. And I'll pause there because I'm sure there's we can come back to these themes over time.
Yeah, I think you're talking about Disney there and their desire to reinvest their dividends into their Disney Plus platform. It looks like we are still missing John. So why don't we move on to Melissa and get a sense of the boardroom, because this year has really been characterized by the pandemic and the subsequent economic crisis and calls for more social justice. So what did that mean for discussions inside the boardroom, and how are directors using their time this year? And as an advisor to boards, how do you think they should be using their time this year?
Well, it is certainly the case that in March, April, May, directors were almost entirely focused on day-to-day crisis management related to the pandemic. They were worried about liquidity. They were worried about business continuity. They were worried about employee health and safety issues. M&A was not high on their list of things that they were juggling on a day-to-day basis. I think as time has passed, even though we're still obviously not out of the pandemic, I think boards now are starting to refocus on longer term issues, and M&A certainly falls into that bucket for a lot of companies. We're in the part of the right now where a lot of U.S. public company boards are actually having their annual strategic planning meetings with management teams where they're developing their 3 or 5 year sets of projections and thinking about what the picture could look like for them in the future. And I think for a lot of companies, that picture will include some M&A. It won't be the same M&A they might have been looking at a year ago, though. The types of M&A that a lot of our clients are thinking about are M&A activities that will help them to diversify. For example, a lot of companies ran into issues with supply chain diversification during the pandemic. So some companies are thinking about verticals or adjacencies that will help them to bolster those strengths, which is sort of interesting because Amy was talking about the role of activists in catalyzing M&A in the past. A lot of those catalysts were to do divestitures, to be more focused and more oriented towards single product lines, less diversified. I think that the sense of a lot of boards now is that actually they can't rely on investors to diversify their portfolios through a basket of stocks in the market for operational reasons. Individual companies themselves may need a little bit more diversity in terms of their product lines and their businesses. And so I think we're going to see boards looking at those different types of acquisitions that maybe had lost in popularity in the past. We're also going to see companies thinking about acquiring R&D and technology that will help them to operate in this new environment that we're living in, where there's less human contact, potentially more social distancing. And then lastly, we may also see some M&A in industries that have really suffered as a result of the pandemic. The retail industry being a classic example of an industry that was already experiencing a secular change and has really been devastated by recent events. And there we may see some M&A designed to consolidate value and just try to retain some standing within the industry.
We'll move on to Makan then, and kind of dovetailing off of what Melissa was saying, Makan, there were a lot of corporations that sprung into action in response to the pandemic. There was a fear, though, that among some of these companies, that collaboration as it pertains to, say, healthcare or PPE or medical equipment even could violate antitrust laws. So how did you, in your seat at the DOJ, balance the need for emergency response with the laws on the books? And you did so, like the rest of us, without going into the office, all over Zoom or some other platform, right?
We have been. Thanks, Leslie. We have seen a number of challenges for us. One is obviously, like everybody else, our staff have been working remotely. A number of us have continued to come in to the office of the leadership, but most of our work has been happening remotely. We have seen deal flow come down, although I'd say this past quarter it is coming back with a vengeance as far as the number of transactions and the merger filings we're seeing. What did change was a lot of collaborations, whether that was collaborations in order to, like a Project Airbridge in order to get PPEs in, or therapeutics like the monoclonal antibodies and the vaccines being developed by a number of competitors. They needed to have quick responses from us as far as what they can do, what safeguards they need to put in place. We immediately announced that what is a process called the business review letter, where businesses will propose future activity and ask for guidance from the antitrust division. Those typically take 9 months to a year, sometimes longer. And we made a commitment that we would review those within 7 business days. I think we have met all of the requests. We've had, I believe, 4 now COVID-related business review letters, collaborations that came through us. In addition to that, the Defense Production Act allows the president to designate certain activities as an emergency and a collaboration that occurs under the auspices of FEMA. And we had to be involved with them and HHS for some of those activities, and they get antitrust immunity.
Oh, now we can hear you. Yes, I can hear you, Megan, and I think I can also hear John now.
I think John's working again.
John is back. Megan, I'm curious if you're still seeing collaboration take place. Here we are, I guess, 7 months into the pandemic. Are you still reviewing these types of mergers on an expedited basis?
So these are the activities that they're doing. So this would be the collaborative activities that the companies put together that we have been looking, and we have been turning those around within approximately 7 or so days. The mergers have continued to take the traditional time that they have taken. Obviously, there's some challenges with getting evidence. We can't do those in person. You don't take depositions. You do those online. But by and large, those have continued to go along smoothly. We are seeing earlier in the year, we saw less merger activity, but as I've mentioned, we're seeing those numbers tick right back up, probably due to the more favorable credit markets.
I think we can now move on to some bigger trends in M&A. And Melissa, I just wanted to start with you and ask you about ESG, or environmental social governance factors in deal making. You recently wrote an article published in Bloomberg Law where you said the growing impact of ESG on M&A deal making is both inescapable and undeniable. What does that mean? And are there a lot of struggling non-ESG compliant companies out there that are essentially toast if they're, kind of seen under this new world of not being ESG compliant?
I think that ESG historically wasn't well applied to the M&A world. I think people were skeptical of whether companies would really do acquisitions that were driven by M&A, or whether buyers would really forego acquisitions where the target wasn't ESG compliant to their standards. But actually, I think we're starting to see this play out in real time, that there are cases of buyers forgoing acquisitions, and there are cases of buyers looking to acquire targets that will bolster their own ESG profiles. I think a good example of that, a really practical typical example of that is if you look in the oil and gas space, where we've seen some of the older, sort of more traditional oil and gas companies doing a lot of acquisitions in the renewables sphere. And that adds to their sustainability credentials. And I'm sure they also have other business reasons for doing it besides just bolstering credentials on paper. But I think that's an example of how ESG is filtering through the drivers of acquisitions. And then certainly in the context of doing deals, people are starting to think about how those deals will resonate with their investors from an ESG perspective. One of the big questions that I think we're going to have to face going forward is that even though the responsibility of boards of US companies is directed toward the shareholders, will this rising tide of populism that we've seen over the last few years and this intense focus on human capital and labor issues, will that affect whether boards go forward with transactions that could be harmful for employees, that could result in cost synergies that terminate the employment of large numbers of employees? I think that remains to be seen over the coming years, but it's definitely something on people's radar.
That's really interesting. I didn't realize that people were using M&A specifically to, bolster their ESG profile. And also to that point, as an activist, the subject of ESG has also captured more attention. I've seen kind of two main styles, and Amy, maybe you can extrapolate on these. But number one, there are funds that are dedicating capital only to companies that are ESG compliant and pressuring for unrelated changes that don't really have much to do with ESG. And then on the other hand, this is maybe more of an up-and-coming strategy. There are funds that are dedicating capital to companies that are not ESG compliant, and they're pressuring them to become so. Amy, what are you watching in this space, and which strategy do you think will prevail and have the greatest impact? And how should management teams be thinking about kind of their vulnerability to activists when it comes to their own ESG profile?
Yeah, and so it's a great question. And I think you're absolutely right. We're seeing more and more companies be targeted by activists specifically on ESG themes. And one of the things that I always say is from the E, S, and the G, the G was always there from an activist perspective. Activists frequently pushed for changes in executive compensation or board compensation. But now we're seeing real change. So, but now we're seeing a real change in that there's focusing more on the S and in the E portion. So E, of course, for specific companies, that's more of a focus where we're seeing there's certain companies that are in, that for environmental issues, you're seeing activists focus on that. But also now you're seeing the S become a really big area of focus to some of the points that Melissa raised in light of things happening in the world right now, whether it be COVID or Black Lives Matter. We're seeing activists now put ESG in the forefront of their campaigns. And I think there's a few reasons for that. And I think the reasons for why they're doing it are the reasons why companies need to be concerned about it. So first and foremost, what I would say is that investors in general, as we all know, and I've talked about even at this conference, more investors are highly focused on ESG. And they'd likely be more supportive of portfolio companies where ESG issues were being prioritized and potentially forced by an activist. And so they might be supportive of those changes. Specifically, what we've actually seen is that we've actually seen activists highlight specific investors' focus or interest. So for example, some institutional investors who are highly focused on ESG, they're likely going to support an activist campaign on these issues, but maybe even more important than the active funds who are acting a bit more like activists these days. One of the shareholder bases that is most focused on ESG continues to be the passive funds or the index funds. And they've always been focused on ESG, and they continue to grow in AUM. And we're now seeing that active funds, passive funds surpass active funds in terms of AUM in the US. And so as more and more of these passive funds become bigger shareholders of corporations, their voting outcome in some sort of activist situation or contested election is outcome determinative. And so when the activists know this, and they're now pushing for these ESG changes because they know that they're likely to get some sort of support. And so I think from the perspective of companies caring, I think that's what makes it so important. It's got to be something that's on the forefront of companies' minds because they know that their investors are highly focused on these issues.
And you probably get a boost from an ESG passive fund, even if you are an active fund, by investing in companies that become more ESG compliant and so forth. John, I think you have resurfaced by phone. So I wanted to make sure before we move on to other topics that we get your thoughts, because I think you cut out earlier when you were talking about some of the key drivers of C-suite confidence in the last few months or so.
Yeah, Leslie, thanks. Hopefully you can hear me now. Can you just confirm that for me?
I can.
Okay, terrific. Good. Well, that's good enough for me. Look, I think the turning point, not to potentially cover ground that you've covered already. The turning point I think we saw in the M&A market came over the summer when I feel that the strength of the equity markets, the prospect of improving therapeutics, the hopes for vaccines and maybe many potential different vaccines started to take some of the pressure off the COVID situation, and large scale corporate M&A is really driven by confidence, and periods of uncertainty are obviously what shut down the M&A market. So I think as the volatility came down, corporate boards started looking more actively, and what you saw in August and September was a return to the M&A market, but I think a very measured return. The volumes came up dramatically, but it was really clustered in transactions in the $1 to $10 billion zip code. And if you really drilled down on those, most of them were transactions that were core to the acquirer or in very close adjacencies. And I think you can put a lot of that under the banner of scale. One thing we learn in periods of crisis is the companies who come out strongest are those with real scale. And I believe that's what's driving the market now. Even though many of these transactions, candidly, you wouldn't put high on the financial risk side because, the acquirer is 10, 20, 30 times size the target. So they're not taking a great deal of risk, but they are back in the deal making business. And look, we'll see how that continues. There's a lot of dust in the air right now between COVID and resurgence around the world, the election, social unrest. These are things which do not conspire necessarily in favor of M&A, and yet I think we as practitioners feel like the activity level right now is almost off the charts in terms of how active we all are.
Yeah, you're right. You wouldn't expect that in the current time period, but to your point, we've seen, especially in the asset management space, scale has become increasingly important as people are looking to bulk up, perhaps in the face of competition. And it doesn't look like there's going to be much clarity to some of this uncertainty lingering out there anytime soon. So maybe people kind of figure now or never. Kind of the opposite side of the coin of bulking up and generating scale is this idea of breaking companies up and divesting companies. That's a subject that's been very much in the news as well. Big tech, antitrust. Makan, I know you've recused yourself from the suit with regard to Google over conflict of interest concerns. But broadly speaking, do you believe that big tech needs to be broken up?
Well, that's a great question. I think before we get to any kind of responses of a breakup, the question is, have they violated the law? So I think it's probably undisputable that some of the companies in the tech space have a large market power, which would be the first test of a monopolization case. The second is, have they maintained that or acquired that illegally? And that's, the job of the enforcers, whether it's the Justice Department, FTC, or state attorneys general, to challenge that. And then you also have to make sure that the remedy. So in the Microsoft case, the Justice Department sought to break up Microsoft into a number of companies. And ultimately, the Court of Appeals said, they have to be commensurate to the challenges, to the violations of the law. So I think there's a lot of steps to go there. There's a lot of political rhetoric about just breaking up companies, and that could be justified. But that remedy needs to be sound. It needs to make sense and repair the market where there has been a violation of the law and therefore a failure. I think the debate we're seeing now calls for a broader discussion about the types of power. You have network effects in these markets that tip the power of a company quickly towards one side or the other, and then you have a reinforcing benefit that the more you use a particular technology or the more users it has, the more valuable it becomes, and therefore it's easier to maintain a certain amount of power. But we've got to make sure that we don't punish good behavior, pro-competitive behavior that actually benefits consumer welfare at the same time that we might be punishing the bad behavior. And those rules of the road are going to be very critical in how those are set. So I think breaking up is interesting. I know there's a couple of pieces of legislation that says, certain companies above a big certain size should be broken up, or certain companies should not be able to acquire another company. Those, I think, may not be totally sound, and we have to take a look to see where do we go. There's consumer effects, there's democracy effects of some of these companies that we're seeing lately. And what is the right policy going forward? And I think there's a lot of debate that needs to be had by the policymakers.
So if I'm understanding this correctly, and I'm not a lawyer, just to put it out there, but my understanding from at least business school is that, the test and the laws on the books as they're written for antitrust is largely based on consumers and the impact of consumers. And a lot of these big tech companies have free products. Search for Google is free, for example. Facebook is ad supported by and large. And so does that mean that the laws need to be rewritten for antitrust? Or is perhaps the case of too much power one that is not antitrust specifically, but something else, another group that should be taking a look at this?
That's a great question. And that's one of the more important things for the consumers and your viewers to better understand what antitrust law is and what it isn't. So yes, a lot of these technology products, whether it's search or social connectivity, are free. However, the antitrust laws apply to the free market. Remember, Microsoft 20 years ago, when the Justice Department brought the case, was giving away the browser for free, the Internet Explorer. But the courts found that they were doing certain things with respect to Netscape's browser and other browsers from entering into the market because it was challenging its monopoly of the desktop. We have a lot of other free products. For example, over-the-air television broadcast has been free for many years because it's ad-supported. That doesn't mean the antitrust laws do not apply. It's how you measure the market power and how you measure the effect of the conduct. So, the size of the company is less of an issue. What they're giving away, the question is, what kind of impact are they having on the competition in the marketplace? And there's an analytical approach that the courts have defined over the years. And I think the antitrust laws is largely well balanced as we have them. It just needs to be applied aggressively and timely. If we fail at our jobs, and there's some arguments that people make that in the last decade, the antitrust enforcers have been asleep at the switch. If we fail at our jobs, then the market fails, and then the challenge is the government can step in and try to repair the market, either with a regulatory regime or something else like they did for, communications and the FCC and other agencies they create. It's best to let the free markets roam. However, for them to be free, the antitrust laws need to be applied.
That makes sense to me. another area that's caught the attention of regulators, although not really DOJ, more the SEC, is this corner of the market that's historically been associated with more of risk taking. And I'm speaking about SPACs, which are special purpose acquisition companies. That effectively means that investors write the equivalent of a blank check to oftentimes a well-known manager who then uses the cash to buy a stake in a company, buy a whole company. Although I think that's on the rarer side. John, how is this impacting both the M&A market and the IPO market? And do you believe that this trend is here to stay?
Yeah, great question. Again, it's a really interesting phenomenon in the broader M&A and equities market. And to your point, the issuance volume this year is up dramatically. It's the highest we've seen in over a decade. There are over 150 SPACs today with over $50 billion in proceeds searching for transactions. And I would say prior to this year as an M&A practitioner, most of us viewed SPACs as sort of a buyer of last resort. And that has really been turned on its head this year. And what we've seen, therefore, are larger and larger SPACs being raised and larger companies being acquired by SPACs. But the reality is to call them an acquisition is a bit of a misnomer. A SPAC is really a hybrid of an M&A transaction and an IPO because the sellers of the company, the so-called sellers, are able to take some capital off the table, sometimes a very meaningful amount and sometimes a meaningful amount in percentage of their ownership. And that's unlike the dynamic you see in regular way IPOs. And yet you end up with a publicly listed company. So it actually provides some very interesting benefits to sellers. I think that the fact that many of these companies have been in and around the technology space, so have a very robust potential growth profile, has led to some of the really strong performance that we've seen from some of these SPACs. Like everything in our world on Wall Street, there's an ebb and a flow, and right now that is in favor of SPACs, the issuance and the transactions they're getting done. I would guess that we'll see that moderate a bit with time, but I can't tell you when. But I do think SPACs are here to stay, and I do think they present a very interesting route to going public, as opposed to the traditional approach. And one thing I'll also add is that SPACs, provide projections in their SEC documents, which is unlike what you see in the IPO market. So investors, get some forward-looking element, and I think that's unique as well. So. Look, it's hard to think of a product that has come on with such force in such a short period of time and completely changed the tenor of how investors and candidly sellers of company, view them. So it's really quite amazing what's taking place. The activity level's off the charts, and I think you're going to see it for the foreseeable future.
Amy, I'm curious your thoughts on what this means for the alt space. Specifically with activists, we've seen several SPAC funds get raised. Bill Ackman's, of course, was pretty famous as the largest ever SPAC, but Starboard has raised one. We've seen Third Point raise one in the past. Why do you think activists are turning to this structure? And is it a reflection on kind of the traditional state of activism in a pandemic? Is this something that you think activists will increasingly use?
Yeah, it's a great question, and you're absolutely right. We've definitely seen activist interest in SPACs, and specifically, if we look at just the activist funds as an aggregate and who's raised SPACs so far in 2020, it's been over $6 billion in terms of capital. So absolutely a lot of money put to work. In terms of kind of what this means and how is it going to be used, I actually think it's a little bit along the lines of a trend we've been seeing pre-COVID in terms of activists acting a bit more like private equity and looking to be owners of businesses or even investing, not necessarily for shorter periods of time, but maybe longer periods of time, maybe not as outright owners, but significant owners over time alongside private equity. And so I think this is a kind of a continuation of that trend, although absolutely what we've seen in the past in terms of activist SPACs, we have seen Bill Ackman raise one in the past and obviously raise one again. And I actually think what's also really important here is I don't think that the aggregate capital that's been raised by SPACs is any indication that we're going to see that money invested towards activist strategies. I think it's actually just a different trend, which is we're seeing more traditional investors be much more open-minded to investing with activist managers. And it just goes to show how quickly these managers were able to raise funds, and just kind of it just shows this real continuation and evolution of sentiment of the investor community being much more open-minded to activism and activist-led investments.
And Melissa, I woke up this morning and was quickly reminded that it's actually 15 days until the election. And I wanted to turn to you as kind of a expert on what's going on in the boardroom to see if you're noticing any trends or any types of deals that are being, maybe incentivized by what people are expecting from the election, or do you see, by and large, people holding off on deal making in order to see what, 2 Tuesdays from now, what happens?
Yeah, it's hard to forget about this election. Look, a couple of things on that topic. I think that we did see the classic sort of juggling exercise where companies were trying to decide whether they wanted to try to get in under the wire in this calendar year for M&A transactions, with the fear that the tax regime could change if they were to do a deal next year. I think that window has already passed. We're probably through the possibility of getting stuff done this year for most large transactions, just given where we are in the cycle. The other thing that is very much on people's minds is where we're going to end up on tariffs and trade wars. And as a sort of separate but related issue, whether we're ever going to be open to cross-border investment from China again. And I say it's a separate but related issue because that's not trade wars, that's also about national security issues, and something that isn't just in the US, we're also seeing the same sort of national security issues in European jurisdictions and Australia as well. And so those are the kinds of questions I think flowing out of the upcoming election that could really impact types of M&A and the flows of capital in and out of the US. And I'm not the right person to make predictions about where we're going to come out on all of that. But I will say, as a deal maker, I just hope we get an answer, because John was absolutely right that uncertainty is a great killer of deals. So I just want an answer.
I think a lot of people shared that sentiment with you. Was someone trying to jump in there? It might have just been some feedback. Oh, yeah. Go ahead, Makan.
On Melissa and others on this is why are we seeing such an uptick in the SPACs? Is there just too much money? Is it the regulatory barriers to go into an IPO? I'm just curious to know what your observation is of why we're seeing the volume of the SPAC raises.
Makan, I'm happy to jump in on that. It's John.
Great.
So I think one of the things that happened this year that may have turned the tide for SPACs, obviously we saw a fair amount of issuance in the last couple of years, although 2019 was probably up about 30% versus 18, and 2020 is up like fourfold. So 2020 is like off the charts. But I think one of the key dynamics that may have changed the SPAC world was the fact that starting in March, for a period of time, there weren't many good exit routes for companies. The corporate acquirers were focused on their operations. You had whole industries that were focused, almost entirely on liquidity. Others were focused on whatever effect they had to deal with from COVID, and the private equity community was largely frozen because, twofold, the uncertainty, but also the lack of any robust, leveraged finance markets. And that opened up an opportunity for SPACs to become, a legitimate acquisition vehicle where they were not relying on leverage, and quite to the contrary. When you look at how a SPAC transaction is broken down, it's some combination of the cash they've raised that sits in trust, cash that comes from the issuance of a PIPE, sometimes forward purchase commitments, etc. And because they're going to be a publicly traded company, when they're completed, they don't want to be over levered, and so their leverage is much more akin to what you'd see in the public markets versus a private equity type leverage buyout. So all of a sudden they were an acquisition class that became essentially the only man standing. And so there were some transactions that were announced, and they did quite well. They were high quality companies with nice growth profiles, and I think that was really the catalyst to put SPACs, into a formidable position in the market. And it really seems to have just fed upon itself here this year. And the other thing I would say is you can't have this kind of issuance without investor receptivity. And so, the old phrase, it takes two to tango. You've got a lot getting into the game. You've got private equity firms that are doing SPACs. You've got former private equity investors that have just gone off and done SPACs. You've got activists. You've got former corporate CEOs, and as I said, it's fed on itself. We've had a robust IPO market, including the IPO of SPACs, and lo and behold, we find ourselves sitting here where the dynamic for SPACs has changed. And as I said before, it'll probably slow down at some point, but the SPAC world has gained legitimacy, and it's really fueled the fire.
Real quickly, Makan, I read a report that regardless of who wins the election, you plan to step down. And I'm curious, kind of before we kick things over to Q&A, what your plans are, and is that why you were asking about SPACs?
That's funny. It certainly hasn't, escaped my attention. But no, that wasn't.
I mean, Gary Cohn has one, so former administration official.
It's a fascinating area. I mean, I had read about them. I remember a former member of Congress, NBA player, who I forget his name now, but he had left about 25 years ago or so and created a SPAC, and that was the first time I'd heard of it. So I read about it, and it was interesting. And then all of a sudden, the last 2 years, we're seeing that. I have said, I've lived probably longer in tenure than most of my predecessors. It's been a phenomenal time during this time in the economy to be serving in this incredible position to be in, which I have loved and enjoyed. But there's a time for everything, and regardless of the outcome of the elections, I will be returning back to the private sector next year, and looking forward to handing the reins to somebody else.
All right. Well, Maybe we will see the Delrahim SPAC come to market. Stay tuned on that front. Well, I just wanted to take the last 8 minutes or so to turn to some audience Q&A that we've been getting. I think a really important topic that someone was interested in is concerns over national security increasingly being used to justify restricting both foreign trade as well as investment. And this person wants to know, is this a concerning development? Maybe Melissa, you would be best equipped to answer that, or anyone feel free to jump in if you have a thought on that.
Yeah, I'm happy to jump in. It's a topic that has created a lot of friction for transactions, in part because our focus on national security in the US has now extended beyond the traditional spheres of infrastructure and sort of real property and nuclear power plants and the energy grid and things like that. And it's now extending all the way to lots of types of technology and software and sort of the Qualcomm world of national security, semiconductors. And so more and more deals are getting caught up in this rubric, and it's just creating, as I said, uncertainty, which can be the enemy of deals. And now that we're also seeing this outside of the US, we're also starting to worry that there could be some retaliation. If the US blocks deals from one jurisdiction, is that jurisdiction going to turn around and block deals involving US acquirers? Some of this regulation is completely logical, but where it gets a little scary for deal makers is where the transactions at issue only have a very tangential relationship to the jurisdiction where the regulators have taken an interest in them from a national security perspective. If you think about a large multinational corporation, it may have businesses in 100 different countries around the world. If you have to navigate 100 different national security regimes to get a deal done, you may never get a deal done. So that's the issue.
Or you hire a lot of lawyers, which may be cost prohibitive. Another question, and perhaps Makan or John, you want to tackle this one. The question is, which industries are experiencing the most roll-ups as a result of COVID, and what are some of the driving forces?
I'm happy to jump in.
John, please go ahead.
Yeah, sure. Look, if you think about businesses that somebody made a reference to earlier that have actually benefited from COVID, right? Companies that provide technology that enhances your ability to work effectively from home. I may be in search of one of those for my new internet here based on my video feed here for this call. But companies like that are well positioned, and it doesn't have to be technology. It could be more mundane, products. There's been a lot of thought to that. I think that probably the most obvious is on the healthcare side, where you think about companies that might be developing therapeutics, but maybe they're smaller companies and they need more capital, and they become obvious candidates for investment or to be acquired. And then there are all the derivative sort of products and services that might go with that. We've all read about how some of these vaccines potentially, are tricky to maintain, meaning they need to be shipped at very cold temperatures and maintained at that temperature until they're stabilized, in a doctor's office or some other place. There are containers that are used for that. So people that provide those. There's the actual administration. There's, how is it going to be administered to people through a typical syringe or some other sort of syringe-like device. So we've seen a lot of offshoots from the drugs themselves where there's interest and activity, and I've probably left out, dozens of categories that that somehow touch what we're all experiencing as we live and work differently, and how we actually go about doing things.
Mr. Assistant AG, I'll give you the word in response to that question.
I was going to say that, we haven't done any kind of data analysis of the current mergers that are happening because of COVID. Of course, there's the activities, the joint conduct that is going on. But what I do see, and something we have seen more recently, is the amount of data that companies are collecting, and I'm not talking about just big tech in order to, target advertising to you, but data that is used for machine learning to improve processes inside of a company. So not just creating the next new, unmanned driving vehicle or TikTok, but just internally using that for insurance purposes or credit and lending. And I would anticipate you're going to see more and more transactions where the data is being used, whether it's upstream or downstream, in order to better improve your internal processes, better predict consumer behavior, better predict lending and risk management. And I think we're going to begin to see that. We've seen that in some insurance transactions and a number of fintech transactions recently. And I anticipate that will continue to grow.
And I would assume that the capacity to pull that data would also allow a company to be maybe acquired at a premium, kind of similar to in the IPO market, where if you can say that you maybe offer a product for free, but you have this really amazing data on millions of individuals, you can get a premium valuation for that capacity.
I would think so, and I think one of the challenges is that people can't put a value for the purposes of that transaction. They know there's going to be gains of trade by making a deal. They just don't know how to evaluate that. And so I think you're going to see more dancing before there's a price discovery for the types of transaction. And that's going to be interesting. That'll keep folks like Melissa very busy, I think, over the coming months and years to come.
Absolutely. Well, it sounds like the four of you will all be very busy for the months and years to come. So I really appreciate you taking the time to join us today. Makan, Delrahim, John Huwiler, Amy Lissauer, and Melissa Sawyer. This was a really informative and interesting panel. So thank you both thank you all four of you for sharing your insights.
Thanks for moderating. Thanks, y'all.
Pleasure.
Very